welcome to Valucop YouTube channel. So today I want to teach you how to use trailing stop loss. So now, what will trailing stop loss do for you? Some of us might be long-term holders that we hold for long term, like we hold our coins for long term, and then sometimes we experience some kind of a bear market that the value of our portfolio drops. The value of our portfolio drops, and because we are holding, and then we are probably waiting to take profit much later in the future, and then our coins are already on profit, but we're not satisfied yet with the profit, and then all of a sudden the market goes really bad, and we lose the progress we've made so far. Now, what will trailing stop do for you? Trailing stop loss will help you. Since your target is long term, you're holding for long term, what you will now be doing as your profit goes up, you will now increase your stop loss. Now, what is stop loss? Stop loss is a risk management mechanism or style that you put to your trade to help you minimize loss if your trade, instead of going up, starts going down. Instead of your trade going the way you want it, and then it starts dropping, start dipping. So stop loss will help you minimize loss. So if you're going to have like 50% loss, stop loss will help you have like 7% or 5% loss. Would depend on the percentage of loss, the percentage that you calculated and you put. So now, what trailing stop does for you is that, take for example now, let me show you. Let's use a coin. Let's use ADA for example. So let's just say you bought ADA at this price at 0.0022 SAT. Sorry, this is BNB. This is ADA BNB. Yeah. Okay, just use data. Or let's just use BNB BTC. So this is BNB. So let's say you bought BNB at this price. After buying BNB at this price, then you expected BNB to get to 0.03 SAT. 0.03 SAT, like when you want to sell. What you will now do is, as you bought at this price now, normally your stop loss, this is your stop limit. You select stop limit, then you now put your stop price. You put your stop price, which is you want it to, this is bought at 0.10870. So you now see that at 0.009 it should drop like 98 or 99. It should drop and minimize loss for you, so you'll be on like a $40 loss instead of losing a lot. $40 loss from the price, and then you now come down here again, and then you say that at the same 0.0099, then you now put that 100% of it should sell off at loss here. Now, what really this is, you're saying that if peradventure that the market starts to go really bad, that let your trade sell off. Let it sell off at this price. Let's sell off at this 0.0099 instead of, maybe if it's going to drop like 0.008. So at 0.009 to now sell off at a minimized loss for you. You will lose some money, but then the money won't be much. Do you understand? The money won't be much. So so in a trailing stop loss now, what you do is that now the price of BNB now moves from your first, you expect to hit like 0.003. So, and then right now it's at 0.01. If the price gets to 0.02, you cancel your previous stop loss and increase it to 0.01. If the price goes to 0.03, you cancel your stop loss again and then increase it to 0.02. What you are doing is that you're taking up like your price like up, you are increasing you're reducing your chances of losing more if the market decides to really go bad. This is what we call trailing. So you are trailing the stop loss, you're taking it up. As the price of BNB is going up, you are increasing the price that your stop limit price that you're using to minimize the loss. So this is one way to make sure that your trades, you don't lose much in the face of a trade. So this is sorry for that breaking transmission. So this is a way to make sure that you don't lose much, you don't lose funds, a lot of funds, if the market decides to go really bad, because sometimes the market will trace or correct and then goes all the way into a bear market. So that's that. I don't know if it was clear to you. If it wasn't clear to you, you indicate and I will explain it again. So it's simple. When you place your stop limits, is usually like maybe 5, 6 or 7% from your entry price. From your entry price, maybe say that you're saying that if I bought at this particular price, if it dips 5% or 7% lower than the price I bought at, let it close the trade for you as a minimized loss. Then if it happens that it didn't drop but it started going up, you cannot increase your stop loss. You increase the price. Now instead of saying close the trade at this particular price, you increase the price that you should close. So that way your stop loss always be closer to the profit, closer to your profit. So eventually when the market goes bad, you will not lose your profit. So this is how to preserve your profit using trailing stop loss. How to preserve your profits when you're holding for long term using trailing stop loss. I hope this made a lot of sense to you. Thank you.